Welcome to the Private Lenders Podcast with your hosts from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, Chris and Jason here, Private Lenders Podcast. Thank you for checking out the show. Real quick, if you haven't done so already, go check out hardmoneymastermind.com, new and improved site, and join the conversation. Join us inside the community. Okay, we're talking about a commercial loan default story. This is a bit of a saga. It's going to be an interesting one that has gone on for some years now, and we just recently exited it. Worked out for all involved. You know, it got a little hairy at times, and we're going to go through the whole story now.
Yeah, no, I think this will be a good one. Yay, we're finally out 5 years later. So I'm going to start by just doing a quick backstory about how we hooked up with this borrower, how we ended up doing a bunch of deals for them over the last 5 years, and, you know, some of the challenges that we had. And I will say that by no means was I ever really nervous about this deal as a default, because we underwrote this as a very low LTV deal to begin with. What do we have? 8 total properties? 8 total loans?
It was more. Some of them paid off, like call it 10 in total loans. A few of them paid off, and then just recently all the rest of them paid.
Okay. So March 2020, right around COVID time, a borrower reached out to us. They had a very large portfolio of commercial assets all over the area, and they reached out because they needed some liquidity. They had very high global cash flow, so they had a lot of cash flow coming in from a lot of commercial buildings they had, but they always had, chances are they lived a pretty high-end lifestyle off these commercial assets. But at the same time, it was challenging for them to, write big checks when they had major capital improvements come in. And that was the challenge. The properties were, I don't want to say inherited by the next generation, but managed by the next generation, because a family owned the properties. The father, in essence, ran them, created a portfolio. He died.
Yeah, he built the whole thing.
Yeah, he built the whole thing. Bought some very, very nice assets over the years that were, are still, good assets. And, in essence, he was running the show. He died. His wife didn't have much involvement in the business to begin with, so wasn't 100% sure how things were running. She kind of had her own little business. So the daughter, in essence, kind of took over and ran it. And they did have a property management company that they own, that they ran just for their portfolio. And they had, I think, like one employee that ran it. But in essence, the whole thing was, I'll use the word mismanaged. I mean, listen, if someone's in their situation, it's challenging, right? Like, yeah, it's very fortunate that they inherit millions and millions of dollars of real estate that brings in millions and millions of dollars a year in cash flow. But at the same time, like, they don't, you don't really know what's up. And over the years, they had very small bank debt on some of the assets. The banks didn't want to renew them because the father was no longer in the picture. And they wanted him as a guarantor. They didn't, their financials weren't as good, just because, like, they didn't know, like, it was all kind of put together, band-aided together. So they weren't all that bankable, even though this thing brought in maybe even $1 million a month in cash flow, in global cash flow. So they reached out to us, and I mean, this came from our website. This was a website lead, and I'll never forget talking to them on the phone and kind of being like, is this a real deal or is this a fake deal? This kind of seems too good to be true type of situation, right? Because they own so much stuff.
Yeah,
and I was like,
we own 100 properties free and clear.
Yeah, exactly. And, like, I'll give you an example of something. We were going to do a property in DC originally, but it was in a personal name. And I was like, listen, typically we only lend to entities in this state. They're like, yeah, I don't want to convert it into an entity because I'm going to have to pay full recordation tax and transfer tax, which is true. And, it could have been 10 G's, and they didn't want to spend the money on that. So they had some level of sophistication, or at least somebody had told them that. So anyways, we picked our first asset that we did. It was either $400,000 or $500,000. But anyways, because I understood who I was dealing with, and, I don't want to call them, they weren't sophisticated. Like, that comes off to be a mean word, but, like,
they're unorganized.
Yeah, unorganized. We'll use that moving forward throughout this episode. Because they were somewhat unorganized with things, I wanted to keep our LTV at around a 40 to 50 LTV. It was partially because it was still early on COVID, didn't know where the real estate market was going. They were unorganized. And, the liquidation value of commercial properties is not like the liquidation of a residential property where you can just fire sale it. This was a single tenant retail building in a very, very good area that was getting very high rent. And I also wanted to make sure that even if the particular properties that we were lending against weren't performing perfectly, I wanted to make sure it could cover the cash flow so they could cover the monthly payments. So that was like deal one that we did. Keep in mind, we're coming in, second quarter 2025. So this is 5 full years. We wrote these as 1-year loans, right? They're all, and that's a challenge with commercial properties, right? Everyone thinks they can pay off quickly, but it's hard to, get out of commercial properties. So we want to make sure that our LTV was structured correctly, that even if there's a really bad market shift, we still felt that we were safe. So that was kind of how the backstory of how we kind of got hooked up with them. And then kind of throughout time later that year, reached out again and said, hey, I've got these other projects, can I take $250,000 out of them, $300,000 out of them? I think the biggest loan we did was $1 million maybe, or $850, something like that. But a lot of them were like $350, $250, $350, $400, $1,000. I think all said and done, we did 10 loans, collateralizing maybe 15 properties for maybe 3.5 mil. And like, that's kind of where we kind of cut it over time. But yeah, that's kind of where, things kind of, went. And, early on, the borrower made all the payments. We had to chase them around a little bit. We got them set up on ACH. And again, if it's a one-off borrower, you can kind of manage that. But like over time, if you're dealing with one borrower, bouncing payments, missing payments, even if they had the funds, it's challenging. Well, just one other real quick thing related, and then we can kind of dive into their performance. But in essence, what would happen is a lot of these were older commercial buildings, and they would need major capital improvements, or they would need tenant improvements or TI in order for them, as they had turnover. And they came from the mentality that their father gave them of, you don't sell real estate. That might be good advice, bad advice. I think you sell real estate as if it goes up in value and you get big cash hits. But like, he never sold real estate, right? So they were like, hey, I might have this building worth $2 million, but I'm not going to sell it. And, they were just, sinking, 13% monthly payments, to us, and it was eating up a lot of their cash flow. So in my mind, it's like, hey, listen, if the debt service is just covering your monthly payment, but you got all this millions of dollars in equity, why not just sell them? But what was happening is they kept needing loans over time because they had these big capital improvements, so they had big tenant improvement costs that they couldn't, get, they couldn't sign some of these tenants, or they couldn't, replace these huge HVAC projects or new roofs unless they had, liquidity events.
Yeah, property taxes too. Property taxes rolling around on a portfolio of that size. I mean, it's a huge number. So yeah, into the performance over the past 5 years a little bit, like you were saying. So we did the series of loans over a couple years. We probably funded them in between like maybe 2020 and 2022, and then they stayed outstanding, something like that. And for most of the time, they were performing. They were, like we said, unorganized and kind of hard to deal with. Like ACHs would bounce, they would switch accounts. We'd have to chase them around in payments. We would say, you ever notice how like borrowers always have their opinion of how many payments they owe you? they're like, no, I just owe you this month and last month. That's it. It's like, well, no, according to actual records, you owe us 5. Oh, I don't think that's right. But anyway, that happens all the time. So that was happening, and over time they did exit some, sell a property, pay us off, stuff like that. But they were hanging around for a long time. And yeah, I mean, a 12.99 rate, like that's not going to look great on your numbers with cash flow properties, right? And granted, this is only on maybe 10% of their portfolio. They inherited this with very little leverage to maybe none, almost no leverage. There is some permanent debt on the other stuff, and then they came to us for the bridge loans. So after a while, it kind of got too much to deal with. And this is last summer. I think we still had 9 loans outstanding, and they were behind on payments on 6 of them, and 3 smaller ones were performing. And it just kind of got to be default time. Like, we're going to send a default letter. We're going to start foreclosure process. Like, this has kind of gone on too long because we're over 4 years at that point on a 12-month loan. So obviously these were being extended annually.
Yeah, let me mention one more thing. So they did refinance one through our process with another hard money lender. But I think the reason that hard money lender originally wanted to do it is we kind of didn't cut them off, but it kind of was like, yeah, we've done a bunch of deals for you. We're chasing you around for payments. Like, they tried to find another source. They found another source. They ended up putting a second against the property that they thought they were going to be first in, and we were the first, and they reached out to me. And then they ended up just paying us off completely and just refinancing it. And they might have sold one other property as well. But again, even if you're, very, very clean, it's still hard to get commercial financing.
Yeah.
And I remember, she was looking, because we were all trying to help her get cheaper debt, right? Like, get bank debt. And I remember it was either 3 summers ago or 2 summers ago. I'm pretty sure it was 3 summers ago. It was 3 summers ago. I was trying to help her, and I hooked her up with this loan broker that we knew that had some decent ties. And I mean, we're talking about like 7% interest rates back then, right? Now, obviously, for commercial paper, it's higher than that, but like 6 or 7%. And like, it took 6 or 7 months, and she was just so unorganized, and she couldn't get them what they wanted. And finally, they're like, forget it. Like, this isn't going to work. So it was kind of, organization is the big key word or lack of organization, which was very challenging with them.
That's about to come up again, because working towards the eventual exit. So this is in like August or September of last year. And they're like, okay, these are in default. HMB is not extending these anymore, and we need to come up with an exit. And so they hooked up with a loan broker. He's not only a loan broker, he owns commercial real estate himself too. He's a pretty savvy guy. And they started working on a plan to refinance these properties. And the broker, he and I communicated a lot, developed a relationship over this past like 6 months or so. And he came to learn pretty quickly that they weren't going to be getting permanent debt. They didn't have the books for it. Like mainly they didn't have he told me they didn't have the financials. Like, they weren't keeping proper accounting per property to really match up with what's going on in their bank accounts. It was kind of a mess. And so he's like, they're a few months into the process it was. And we're kind of in the foreclosure process, but not rushing it too much. We don't want to go to auction sale on these. We don't need to. They need an exit. And so we gave them some leeway. And they realized that permanent debt wasn't going to happen. So now they're going back to the private money route. And so the lender, I believe the one that refinanced them previously, took a look at it. He decided that he was going to do a bunch of these loans, still in a good equity position. I believe with the agreement that they are going to need to sell some of their portfolio to pay this off. You've already tried the permanent debt thing. Sell the leverage part of your portfolio, pay off those loans, take the proceeds that are coming your way, and you still have dozens and dozens of properties free and clear, right? With good cash flow that you can manage properly. That was the plan. And so that it was much more drawn out than that, what happened. And all the parties involved, like the borrower, their attorney, the loan broker, our attorney, title attorney, me, like there was a lot of back and forth going on for the past, this paid off a couple weeks ago, a week and a half ago, maybe. So coming up to the end, it was a good like 6 or 8 weeks of communication about getting this to the table. And it eventually did. We negotiated down our interest rate that we collected. So it came out somewhere in between default and regular rate. So perfectly fine return. Did a favor for them. Because the loans had been extended so many times, there are a good bit of extension fees coming our way too. And at the end of the day, it worked out. It just paid off 9 loans all in one day. Well, all in one day after, months of micromanaging this process. But all in all, it was a successful exit for everyone involved.
Yeah. So a few rules of thumb with these particular deals, because like these could be good deals to get. And, when you find commercial property owners that I mean, listen, if you got to go to a bank and they want to see your tax returns, they want to see your rent rolls, they want to see updated financials, like even if you got great credit and you have all that, there's still no guarantee that they're going to get a loan. And keep in mind, a bank doesn't give a crap if it's an 80 LTV or a 10 LTV, right? It's still a very guarantor heavy type of deal, particular deal. Besides, debt service coverage, that's kind of the only difference on that side if it works on one side. But like, at a certain LTV, you don't want to set up a bar for failure, obviously. But at a certain LTV, like, if the deal makes sense, you could capture deal flow like this. This isn't the only we have another scenario exactly like this. They're not really in default. They're pretty up to date at this point, but like it's a similar situation where it's like second generation took over a portfolio of commercial properties. But, in general, as markets change, as market shifts, like there's opportunity to do loans on commercial assets. But a few takeaways that you got to be careful about. Like you really shouldn't be lending higher than 50 LTV on a commercial property unless you really know that area, you're really comfortable with it. And I mean, let's be honest, commercial foreclosure is typically easier than investment property for residential foreclosure. It's usually quicker, it's cleaner. You're dealing with a little bit more sophisticated borrower, things like that. So like that's all in your favor, but at the same time, it's very unknown what some of these commercial properties are worth. And what it might be worth today might be different for tomorrow if that tenant goes in distress and the tenant moves out, right? Or if they're operating the property themselves. I mean, we're very, we look deep into the income approach. We look deep into the, sales approach. We look deep into the replacement value approach. Like we're analyzing these things a few different ways. And then we're trying to come up with a conservative number and then lend 50% max, sometimes 40% on these things. Because in essence, the income approach is just, gravy, on it, icing on the cake, I guess you can say, because let's be honest, that tenant might not be there forever. And I know banks are heavy on income approach. They want to know that cash flow is coming in. And I agree with that approach. And we use that. But at the same time, like, I don't want this property to be worth zero or very little if that tenant moves out. So, we dive into like, okay, on an open market, what would an investor pay for this thing, in average condition based on what it's at. So take all that stuff into consideration. I wouldn't lend on commercial properties if it's in not a great area. You want to be in an area that could be bankable, could get bank financing. But there's a big opportunity for small balance commercial properties. We do them every month. And, if you can get your hand involved in some, you got to understand that you got to make sure that they have some sort of exit strategy or they can figure out a way out, because the exit strategies are tough. They're challenging. And, I'm not, our goal is not to foreclose on any of these things. If the borrower is making payments, we're going to do extensions to keep them going. We didn't really have any issues with this project until they just got so far back, and we just, we're sick and tired of chasing them around. Think about what happens when you process an ACH payment or a borrower makes a payment and then it bounces. And then you have multiple investors involved. Then that happens on 10 different loans at once. Like the domino effect is a pain in the neck. And then you're chasing them around and be like, oh yeah, I need to put more money in that account. I got to do that. It turns out to be a nightmare. So it was like, listen, you're too far behind. You're not catching up. We're going to have to pursue foreclosure on this thing. And, we gave 5 years of leeway. So just be a little bit more cautious on some of these commercial deals, but there's a lot of good opportunity, especially the small balance commercial stuff. You have very little competition in that space. Just really try to be at that 40, 50 LTV deal. I know that's hard when, like, I give you an example, someone's going to buy a property for $1 million. They say, hey, I got 350 I could put down, or 400 grand I could put down. It's like, that's all, it looks good, right? It feels good. They're bringing so much money to the table, but who knows what the actual value of that commercial property is. People are still overpaying for things. So you could be doing, a $600,000 loan on a $1 million purchase price where really the value is only $750 to begin with. So be careful and, try to do lower LTV deals on assets like that.
All right, everyone. That is the pod for today. I hope you enjoyed the story. We'll see everyone here next time on the Private Lenders Podcast.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice.
Please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.